Welcome back to another episode of Money Matters. In today's episode, we're going to be talking about Investing 101. So the aim of today's video is to help everyone invest better and to follow the fundamentals of good investing. It's particularly relevant today because it's the 13th of March 2020. The coronavirus has hit markets pretty hard and everyone's talking about the markets. Everyone has their own ideas and theories and when to buy in, when to jump out. And actually, I think it's very prudent to remind ourselves of the fundamentals of what makes successful investing. So hopefully I can share my perspective with everyone today so that we can take a calm and steady approach to investing and better managing your wealth. So I'll be covering several points about good investing and I'll cover the basics. Bear in mind that everyone's at different levels, so forgive me if some of these topics might come across as a bit basic, but let's start with the basics. Before I begin, first thing, let's start off about talking about the term investing. What we're not talking about is trading. If you're a day trader or behaving like a day trader, this video is probably not for you. What we're not trying to do is time in and out of the market to make a quick buck. We're not sitting here with multiple screens doing loads of technical analysis. Investing is about buying assets that will generate you returns over the typically medium or long term. It's usually intrinsically linked with your bigger picture financial planning. So I've said this many times before and I'll say it again. Before you begin an investment, you should determine your investment objective. And I don't mean a vague objective such as making some returns around 5% per annum or generating some yield. We must ask the question, why are we making this investment in the first place? Break down your motives. I won't go any further on this particular topic as I'll cover this in another video. So let's start with the four main asset classes. These are cash, bonds, property and stocks. These all generate a return which you can break down as either income or gains. Cash will simply deliver you an interest. You put money in a bank, they give you an interest in return. With bonds, there are many terms to bonds, but what we're talking about is lending money to governments or corporations. So if you buy a bond, you will typically receive a coupon rate. The coupon rate is essentially the interest rate. So if you buy a bond from the secondary market, you buy it from another bondholder, you can buy it at below par value. So if the par value is 100, you buy it at less than 100, you should stand to make a gain if you sell it back at par value. This either happens if you sell it back to another buyer at a higher value, or if it matures, you receive in return par value, 100% of the bond value. You also receive interest in the form of a coupon rate. It's traditionally called a coupon rate because in the old days, you literally take your coupon to the office and pick up your interest payments. With property, you buy a property at a certain value, you receive income in the form of rental income, and then if you sell it back to the market, if you sell it at a higher price, you make a capital gain. Finally, with stocks, or otherwise known as shares, if you buy a share in a company at a certain price, and later on the price of that share is higher, and you sell it back to the market or to another buyer, you make a gain. Also, the company has the discretion to pay you a dividend. So as a shareholder of the company can decide whether or not to pay you a share of the profits. This is called a dividend. Now, you can either buy these directly, so you can hold a single bond, or you can buy an individual property, or you can buy a certain stock or a share. However, you can also buy them within a fund. So there are bond funds which holds a collection or a variety of bonds, and that gives you a broad position across many different bonds. It allows you to buy many bonds in one go. Same with properties as well. There are property funds, typically called REITs. This again allows you exposure to many properties, and therefore you have a diversified position across the markets. Also with stocks as well, these are called equity funds. Again, this allows you to hold many different shares from a variety of companies. So when you hold these funds, these are called collective investments, where you have a diversified portfolio, and it's not just your money. There are many other investors also buying into this fund, and there are certain advantages to this as well. So one of the advantages with collective investments is that you're creating a diversified portfolio. You're spreading your risk. You're not putting all your eggs in one basket. So let's say if there were 3 supermarkets that dominated the market, and instead of buying just shares in one supermarket, you buy shares in all 3. The advantage here is that, let's say if one supermarket was to perform particularly badly, you would presume that the other 2 would pick up the business from that supermarket. So you make a loss in one share in that supermarket that performs badly. However, the other 2 would pick up the business from the loss of that one supermarket, and you would make gains in the other 2. So this is diversifying your risk. Also, when buying a collective investment, typically there might be some sort of fund manager who manages that investment for you. You're leaning on their expertise to manage that portfolio for you. They have access to information that you might not have, and you're leaning on the expertise to pick the right positions in the market. Finally, there are economies of scale. So it's not just your money going into the fund. Many other investors also have access to that fund, and therefore they also put their money in as well. Economies of scale simply means that because the fund is quite large and the fund manager is dealing with large sums of money, there may be economies of scale when he's buying into certain positions. So going back to bonds for 1 second, if we look at this bond right here as an example, it's Jaguar Land Rover, the automotive maker, and here they are paying an annual coupon rate of 5.625%. So this is the interest rate you will receive by buying this bond, and you receive 5.625% per annum. This bond was issued on the 28th of January 2013, so it's already on the market. You're buying it from the secondary market. It has roughly 2.8 years to maturity. When that bond matures, you'll receive back 100% of the par value of that bond. So if you buy it at a price of 99 or 98, and you wait until the maturity, until that bond matures, you stand to make a gain on that bond, plus the interest payments as stated in the annual coupon rate. Each bond will have its own credit rating, so this gives you an indication of the risk of that bond. There are credit rating agencies such as S&P, Fitch, and they give a rating such as, in this case, B or BB. And this gives you an indication of the risk you're taking on by buying this bond. So with property, I think most people understand property. Let's say you buy a property that's worth $1 million Hong Kong dollars. That's the price you paid. You decide to rent it out. Now, the rental income that you receive should cover your mortgage payments. Most people will tend to take out a mortgage when buying a property. And this is one of the big advantages of property, is that you can leverage your return. You stand to make a far higher return on your investment by leveraging and gearing your property. So in today's environment, you can borrow money pretty cheaply. The rental income should easily cover your mortgage payments, and therefore you stand to make a net profit on your rental income. In years past, whenever you decide to sell this property, you should be able to sell it for a higher price than when you bought it. Therefore, you make a capital gain as well. For shares, quite simply, let's say if I bought Apple shares at $200 a share and years on I decide to sell again at $300 a share, I've made $100 per share. During that time I hold that Apple share, Apple may or may not pay me a share of the profit. So this comes in the form of dividends, and I stand to make an income during the time I hold that share as well. So there are pros and cons of buying direct positions in the market, i.e. you're buying stocks in specific companies such as Apple, Microsoft, JP Morgan, whoever, or buying a collective investment. If you are buying specific positions in the market, then you are essentially taking a bet on whether these specific companies will do well or not. If you're taking a diversified, broad position in the market, i.e. you're buying a collective investment, then you're essentially riding the market. It's more of a buy and hold strategy. When you're riding the market, you are essentially believing that markets will eventually go up, which it does. So there's nothing wrong with a buy and hold strategy. However, when you're buying specific positions in the market, you're using what's called tactical allocation. You are to some degree taking a bet on specific positions that you're buying, and also to some degree timing in the market, trying to buy stocks that are cheap or low cost at that time in the market with the belief that it's going to go up. So cash versus bonds versus property versus stocks. The general rule of thumb is that stocks is more high risk than property, which is more high risk than bonds, which is more high risk than cash. Now, when we're talking about risk, we're talking about volatility risk, the price movements of that particular asset. Now, it's a very general rule of thumb. It doesn't mean that all bonds are more risky than certain properties, are more risky than certain stocks. And lest we forget, we are only considering volatility risk. Now, if you hold all your wealth in cash, that doesn't mean you're necessarily safe, because cash will lose out to inflation, and therefore you're suffering inflation risk. Or if you take a too cautious approach to your investments, then you suffer something called shortfall risk. So by not taking enough volatility risk, there are other risks to be considered as well. So you must find a balance that suits you and suits your investment objectives and your life goals. The next point I want to talk about is keeping it simple. I want to encourage people to stop using too much technical analysis or trying to find patterns in the markets where it's their secret formula to making a quick buck. Or perhaps maybe using hearsay, word of mouth, or information that they think is secret where it's going to lead to instant profits. If they know about it, or if you know about it, it's probably already publicly available information and it's already priced into the markets. So I also want to change the terminology we use. I think this is a phrase that Warren Buffett uses. Instead of buying stocks, if we can think about buying businesses, I think a lot more people will be successful with their investments. So think about which businesses you would like to be a business partner of, and what we're talking about here are picking businesses that you think will perform. What does that mean? Picking businesses that you think will make great revenue, earnings, maybe it's growing, and ideally earnings that are above and beyond expectations. The general rule of thumb is that by picking larger businesses, these are called large caps or mega caps, that they are safer investments compared to small caps or mid caps, because they can better weather economic downturns. They maybe have more cash in the bank, or they have a larger market share, and therefore when there's an economic downturn, they can better weather that downturn. So with larger companies, you can expect potentially a gain on the price, and also perhaps because they're making serious profits that they'll be paying out dividends as well. With the smaller companies, the small caps and the mid caps, you're more relying on the fact that they're a small company, they have room to grow, they can have the potential to maybe they're finding a new market that they're breaking into, or they're eating into a competitor's market share, and you're really relying on their gain on the price of that particular company. The next point I want to make is to encourage investors to avoid market noise. Information you hear in the news is always myopic, it's always short term, because we're talking about, the S&P 500 has fallen X number of points today, or this has happened, that has happened, and it's always talking about a very short period of time. However, investors, if you're investing, like I said before, you're not trading, if you're investing, then you have a totally different time horizon. You're typically investing for years rather than days or weeks, and therefore this information you have to, of course, take it in, but don't just take it at face value. Particularly, don't just read the headlines. Headlines in particular are of a very negative nature. It's what people say is clickbait. It encourages people to read that or to capture their attention. If you do see an article that's interesting, click into it and actually read the full article. Never just read the headline. Talking about picking and managing investments yourself versus hiring a professional, I've done a separate video on this in the past, and here's the link to that video. So, whether you pick a well-diversified portfolio and opt for a buy and hold approach where you're riding the markets with the understanding that markets always eventually go up, or you take a more tactical approach where you're picking very specific investments and you are using an element of timing where you're buying cheap stocks or cheap assets at a particular time in the market and selling at a later date, I would say try not to overthink it. And actually, the best advice I can give, and probably one of the most simple tips you can ever take on board when it comes to investing, is to get involved as early as possible and take advantage of the effects of compound growth. Now, let me finish with compound growth, because it doesn't matter how many times I talk about this, it still amazes me every single time. So if we're focusing on time as being the main factor in this investment, let's use an example of putting an initial investment of 100,000 USD per month, taken from your salary, your income. You put $500 per month, and you're investing for 30 years and benefiting from an interest rate or growth rate of 10% per annum. And therefore, after 30 years, your total contributions will be $280,000. However, the value of your portfolio is $3.15 million. Now that's the benefit of compound growth. Now you can argue, well, okay, the 10%, that's far too high. No, it isn't actually. If you do some research, if you look at how markets generally perform, on average, over the history of indices, then you'll see that actually a lot of some indices does give you double-digit figures over the past 30 years. So it's perfectly feasible. So I know some people will say, oh, I don't have 100,000 USD to invest. I don't have 500 USD per month to invest. Yes, okay, so it's different for different circumstances for different people. But you invest the amounts that's relevant to you. So if you earn slightly less, you put slightly less in. But it's relative to how much you earn. You want to try and put as much of your earnings as possible into the markets as soon as possible. So that's my video on Investing 101. I'm sure I've missed many, many topics. It's a very broad topic. So any questions, please put your comments below. I'll try and cover other topics relating to investing through other videos. Leave your comments. Let me know what other videos you want to see, and I'll see you on the next episode of Money Matters.